This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City, the evening of June 15th. When does inflation turn into stagflation? When do price increases creep up to the point where economic activity slows to a halt? We don't know exactly, but it could have been last month when retail sales declined by 1.3%. In fact, given inflation that month, over 2%. That disappointed Wall Street today. There was a modest drop in stock prices during the New York session, but it could be the harbinger of a great deal more to come. If you look at the chart of the day, you see the major categories of the producer price index. That's wholesale prices. It's not simply that inflation is running above the trend. It looks like the trend ran up against a brick wall at 100 miles an hour, and many major categories of goods are rising at double-digit, nearly triple-digit rates, including lumber, plastics, metals, and of course energy. Oil prices hit a new cyclical high at $71 today, and that's not a matter of short-term market fluctuations. There's a structural problem. We have chronic underinvestment in energy in the United States, as I reported yesterday, and a continuing increase in demand. So when you have a reduction of supply and an increase in demand, you're going to get higher prices. What's happened is that prices are rising faster than wages. Wages, according to the Atlanta Federal Reserve's wage tracker, are running at about a 3% annual rate of increase. But inflation, depending on how you calculate it, the instantaneous rate of consumer price inflation last month was 8.7%, something we haven't seen since the 1970s. The so-called sticky inflation rate that the Atlanta Fed calculates, that prices that typically don't move very far, well, that's rising at a 4.4 annual rate. So whatever measure you take, prices are rising faster than wages, and to make up the difference, people will either have to dip into savings or borrow, and often they don't like to do that. So that's the danger of stagflation. Inflation is a nasty, regressive tax on lower and middle income households. It penalizes people who don't have the means to hedge their portfolios successfully. Richer Americans who can buy inflation hedges, including houses, will probably manage to reduce the impact. But for most American families, this is a tax. It reduces their real income. The beneficiary of the tax, as normally, is the federal government. But instead of taking money out of people's pockets, they're taking out purchasing power and at the same time reducing the real value of debt service payments. It turns out that what the Biden administration and the Federal Reserve are taking out of the pockets of American households is even greater in the last couple of months than the stimulus checks that they've put in. That's a recipe for stagflation and an eventual recession. So be afraid, be very afraid. This is David Goldman speaking to you from New York.